Before we begin, I want you to pay very close attention today because what I'm about to break down for you could seriously impact your portfolio over the next few days. Opendoor just had one of its most interesting trading setups in weeks. And behind the scenes, something big is happening in the broader market. There's over $7.6 trillion sitting on the sidelines. Short interest on Open is getting strange, and the Fed's next decision might completely flip the direction of growth stocks. So if you're holding Opendoor, trading it, or even thinking about entering, you absolutely need to hear what's coming next because this week could get volatile fast. All right, let's get straight into it. So Opendoor closed Friday down about 5.67%, and naturally that freaked a lot of people out. But the first thing to understand is that a pullback like that doesn't automatically mean something bad is happening. Most likely it was more of a consolidation move, especially considering where the stock bounced from. I'll explain that price level in a moment because it's more important than it looks. Now, this week is shaping up to be a major one, not just for Opendoor, but for the entire U.S. market, because we're heading straight into a heavy lineup of economic data. Monday is relatively quiet, so whatever movement we see will probably be driven by technicals. But starting Tuesday, the market might get choppy. We've got JOLTS job openings and we've got ADP employment data. Last week, ADP actually came in negative at Main at 13,000, which raised a lot of questions about how soft the labor market is getting. And JOLTS has become a surprisingly powerful market mover over the last year. Whenever job openings come in too high or too low, you see the entire market react instantly because people start pricing in what the Fed might do next. But the real event, the one that genuinely matters this week, is going to be Wednesday. That's when we get the next interest rate decision. Now, right now, the market is pricing in about an 86% chance that the Fed cuts rates by 25 basis points. Most analysts already consider that the default outcome. But what's actually going to move the market is Jerome Powell's press conference afterward. If Powell even hints toward the possibility of another cut coming in January, that could be the spark the broader market is waiting for. Because here's the crazy part. Just last week alone, roughly $86 billion left both equities and crypto and went straight into money market funds. People are scared, uncertain, and they'd rather sit in a safe 3 to 5% return than risk buying stocks before they know what the Fed is planning. Right now, U.S. money market funds are sitting at an all-time high of $7.65 trillion. That's money that could rotate back into the market very quickly if the Fed gives the green light. And guess who benefits the most when money rotates from safety back into risk? Growth stocks. Exactly the category Opendoor falls under. Moving back to Open specifically, there isn't much scheduled for the company this week. No interviews, no fireside chats, and the executive team has been unusually quiet on social media. Honestly, this might be intentional, because sometimes silence actually helps shift the narrative. The less noise, the fewer opportunities for shorts to pick at weak sentiment. Now let's talk about something interesting, short interest. As of now, about 13.67% of the free float is being shorted. That equals roughly 107 million shares sold short. But here's the weird part. The number of shares on loan is only around 79.6 million. Normally, these numbers should line up pretty closely, but here, they don't. And whenever there's a discrepancy like this, one possible explanation, though not guaranteed, is naked shorting. I'm not saying that's definitively what's happening, but the math is suspicious like it has been before with other small to mid-cap growth stocks. If you're someone who believes in potential squeeze setups, Open checks more boxes now than it did a few weeks ago. Its current short squeeze score sits around 55, middle of the pack, but still noteworthy. Let's talk options sentiment for a moment. Options traders seem to agree on a target around the $8 range on the bull side. On the bear side, the expectation is somewhere between $6.50 and $7. Considering Open closed at $7.15 on Friday, the upside looks more available than the downside, at least according to positioning. Now let's break down the key levels you need to watch. At $7.15, the stock is trading between a pivot level and the S1 support. There's a very strong support at $6.99, and interestingly, it wasn't tested at all on Friday. That's a good sign. On the upside, the next major resistance is $7.57, which is exactly where Open rejected last week. Whenever a stock hits a major resistance level, a pullback is extremely common. That $7.57 rejection could be the main reason the stock dropped on Friday. Classic resistance behavior. On the charts, what I want to see is simple. Open needs to push above the 50-day moving average. If it does, that typically signals growing momentum and is a positive sign for growth stocks. If things go south, if Powell sounds gloomy or signals no cuts until much later, Open could pull back to the 100-day moving average, which is currently around $6.16. That would be the absolute bear case scenario. But the bull case? Much more interesting. If the Fed cuts 25 breaths and Powell even slightly hints at another cut in January, investors could shift heavily into risk assets. That type of rotation could push Open to retest the $9 range earlier than expected. Now, for those who follow Elliott wave patterns, here's something worth noting. If Open manages to break above $8.99, the Elliott wave structure suggests a potential move toward $10.50 to $11.43. Not guaranteed, obviously, but technically possible. So overall, here's how I see this week. It's shaping up to be big. Not just for long-term investors, but especially for day traders and swing traders. Increased volatility, major economic data, a Fed decision, and unusual short interest behavior create the perfect setup for big moves. Personally, unless Powell shocks the market with negativity, I think Open could finish the week in the 8.15 to 8.51 cent zone. That lines up with R1 and R2 and would represent a healthy recovery. Now I want to hear what you think. Do you see Open breaking above $8 this week? Do you think Powell will hint at another cut? And what price target do you have for the end of the week? Drop your thoughts in the comments below. Disclaimer: this video is for educational and entertainment purposes only. Nothing in this script or video should be considered financial advice. Always do your own research and consult with a licensed financial advisor before making any investment decisions.